Learning Objective D, prepare consolidation journal entries for fair value issues at acquisition and subsequent balance dates. So this objective is going to be quite practical, and it's going to apply what we've talked about in learning objectives A, B and C to or in a practical sense. So firstly, an acquisition analysis. This compares the cost of the acquisition with the fair value, not the book value, of the identifiable net assets and contingent liabilities, or for short, fair value of identifiable net assets, FVINA, that exists at acquisition date to determine whether there's either a goodwill on acquisition, whether the cost is more than the fair value of identifiable net assets acquired, and you're going to expect that 90% of the time, or gain on bargain purchase, where the cost is less than the fair value of identifiable net assets acquired. So it mentions in this second point that goodwill is an asset which represents the FEB, which is a future economic benefit arising from other assets acquired in a business combination that were not individually identified and recognized. And it's a residual value. So after identifying any contingent liabilities that weren't already there, or any intangible assets that couldn't be recognized because they were internally generated, once they're all identified, the residual goodwill remains. It also mentions in the third point here that net assets equals assets minus liabilities equals shareholders' equity. They equal the same thing. It's just rearranging the first year accounting equation we learned about, which is assets equals liabilities plus equity. The first 2 points on this slide just re-emphasizes what I was discussing on the previous slide. So there may be some new assets and/or liabilities recognized as part of the acquisition because they now meet the recognition criteria, and they've got to be recognized at fair value, not their cost value. So if there's a difference, it needs to be adjusted. Now the third point here says we commonly determine the fair value of identifiable net assets with reference to the equity balances of the subsidiary rather than the individual assets and liability balances. And why is that? Because they're the same thing. So instead of listing out every individual asset account, then deducting each liability account at their respective fair values to determine what the net assets are, another way to go about it is just to write out the equity balances of the subsidiary, then write out the adjustments to the assets and liabilities, the equity portion that results from that, so the increase less the 30% tax effect, and that will equal net assets as well. Because as the basic accounting equation we looked at last slide goes, assets equals liabilities plus owner's equity, or equity rather, taking away the owners. If we were to rearrange that equation, it would go assets minus liabilities equals equity, which is net assets, the same thing. So at the end of the day, we're writing out the same, we're getting the same answer, the same calculated figure, but it's far less cumbersome to just write out the equity balances than each individual asset and liability account. Okay, so let's look at an example now, and this background information will go over a couple of slides. And as it says here, that Hi-Tech acquired all of the issued capital, so it was 100% acquisition here, of Low-Tech on the 30th of June 2016, and the cash consideration paid was $400,000. And at that time, the net assets of Low-Tech were represented as follows: $300,000 of share capital and retained earnings of $50,000, which equals a total net assets, that's the book value, of $350,000. So we'll go over to the next slide now and figure out if there are any assets or liabilities which weren't at their fair value, and we'll need to determine what that increase or decrease is to figure out what the fair value of identifiable net assets are. When high-tech acquired its investment in low-tech, the following information applied. There was land held by low-tech which is undervalued by $10,000, so that means we have to increase it $10,000 within the consolidated accounts. A building held by low-tech was undervalued by $45,000, so we have to increase that as well. And it also tells us some information about the original cost and the depreciation rate, and that is information that we'll use not in the acquisition analysis, but we'll use that later with the consolidation journal entries. There was also a contingent liability related to an unsettled legal claim which had a fair value of $3,000, and that was in the notes, so it didn't meet the recognition criteria in the subsidiaries accounts, but on acquisition we'll recognise that. And it mentions here as well that the tax rate is 30%, but we could assume that anyway, as we'll always be using a 30% tax rate in this subject. Okay, and here we have an acquisition analysis. It does mention in the heading here that there's no previously held equity interest, and I'll talk about that a bit later as to what would happen if there was an interest previously. But let's just look at these figures for the moment. First, we have the cost of the acquisition, which was stated on slide 33. There was $400,000 paid, which is the cash consideration. And now we have to compare that against the fair value of identifiable net assets. So first we're going to start with the book value of the net assets, which is the share capital, the retained earnings, which is $350,000. That's the equity portion. And then we have to make these fair value adjustments. And first we have the after-tax increase of land, which is $7,000, and how that's calculated is it was a $10,000 increase less the 30% tax effect is $7,000. So we're not including the tax portion because we're recognizing that 30% amount as a future tax payable. It's a deferred tax liability in the future when it's sold for that increased value. And so it's recognized as $7,000 there. Same with the buildings. It was recognized as a $45,000 increase, and so the less the 30% tax effect would mean it is a $31,500 adjustment to equity. And we also had this contingent consideration, which was the provision for the legal claim, and that will be a deduction of 3,000 times 30%, 2,100, and that will reduce the fair value. So in total, these adjustments equaled $36,400, and that will be added to the equity value of the accounts of $350,000, which equals a total of $386,400. And we're only multiplying it by the 100% acquired because that's what we use in topics 3 and 4, only 100% acquired. And when comparing that $400,000 consideration against this figure, we're left with a residual goodwill amount of $13,600. So it does give you the option here, if it was in brackets, if it was if the consideration was less, that would result in a gain on bargain purchase. So if there was a previously held equity interest, for example, high-tech previously acquired, say, 15% of low-tech 6 years ago, and they were just acquiring the remaining 85% as at 30th of June 2016, 6 years later, the acquisition analysis and the consolidation entries would remain unchanged. However, there'd need to be some additional entries required to the parent's books following AASB 9 financial instruments. We'd need to recognise the increase or decrease to the fair value of this portion within the profit or loss accounts, unless they recognised the adjustments in other comprehensive income when they made that that decision as to how to recognise that portion. And yeah, that's not going to be too much of an issue. Most of the questions won't include a previously held equity interest, but I just wanted to mention that there, how you would account for that where control is achieved in stages. So yeah, in conclusion, the previously held equity instrument in the acquirer must be adjusted to fair value prior to performing the acquisition analysis. So on the next slide we'll look at we'll just talk about this a bit more, what's going on here, and then we'll look at some of the journal entries, the consolidation journal entries that follow on from this analysis that we just completed. So if the book value of a subsidiary's assets and liabilities doesn't equal fair value, or a contingent liability exists, which just occurred on the previous slide, it's necessary to make business combination valuation adjustments. And these would include either increasing or decreasing the subsidiary's recorded assets and liabilities, book values to their fair value, and recognizing new assets such as internally generated intangibles, and recognizing any contingent liabilities. So the BCVR account is used, that clearing account I mentioned earlier, to record these adjustments, and I guess you could think of it as being similar to the asset revaluation surplus account you looked at in ACC322 when we did property, plant and equipment. So it is possible for some of these adjustments to be made directly in the books of the subsidiary, as I mentioned earlier. So for example, instead of remeasuring the land and or just in general property, plant and equipment on consolidation, you just perform the fair value adjustment within the subsidiaries accounts prior to preparing that consolidated accounts. However, there are some types of assets and liabilities which that isn't an option, and you have to prepare it via the consolidated accounts. And most of the time the questions you'll get given, they'll say prepare the adjustments within the consolidated accounts, not within the subsidiaries accounts. I think all our questions actually are like that. But anyway, just to provide some context, inventory is dealt with under AASB 102. It has its own standard, and it states that inventory is to be recorded the lower of cost or net realizable value, and therefore any increase to fair value of the inventory cannot be made within the subsidiaries account, so there's no choice but to make a fair value adjustment to inventory within the consolidated accounts. Also, AASB 138 intangibles doesn't allow a subsidiary to recognise internally generated goodwill or internally generated assets unless they're considered development. Anyway, without going too much into that, also that applies with contingent liabilities as well if it doesn't meet a provision. So as a result, it's more likely these adjustments will be made via the consolidation process. So in our example, land was undervalued by $10,000. So as part of our consolidation journal entries, we need to adjust land and increase its value by $10,000 via a debit to land. The other side of the equation, on the credit side, we would firstly increase the deferred tax liability account by 30%. So 30% times $10,000 is $3,000, and that's because we're increasing land above its carrying amount, and because of that, if that amount was to be realized, as in we were to sell the piece of land for $10,000 more than what its cost was, or carrying amount rather, that portion would be considered a gain, and we would have to pay 30% tax on that. So following what we learnt in topic 1 with deferred tax, we are recognizing that portion now within the consolidated accounts. And then there's this $7,000 credit to BCVR, Business Combination Valuation Reserve, and this is a clearing account. However, for the moment we keep that balance there, and this amount, the BCVR will later be cleared, and we'll look at that in a minute, but for the moment this is the entry you would perform to increase the value of land to its fair value within the consolidated accounts. So now looking at buildings, which was undervalued by $45,000, we need to increase the value of the building so within the consolidated accounts it shows this $45,000 increase in value, and it's a slightly different process to what we applied in the previous slide because buildings are a depreciable asset. So we were told the cost and the accumulated depreciation amounts, which were $100,000 and $20,000 respectively, and deducting that accumulated depreciation leaves us with a book value of $80,000. That means the $45,000 needs to be applied to that $80,000, which would bring it up to the fair value of $125,000 within the consolidated accounts. Here we have the consolidation journal entry that we would prepare for the buildings. So we've got a debit here to accumulated depreciation $20,000 and a credit to building for $20,000. So this would bring the building back down to its $80,000 carrying amount, and we've reversed all the accumulated depreciation that was applied within the subsidiaries accounts. Then in the next entry we've got a debit to buildings of $45,000. That would bring it up to its $125,000 consolidated account value, and then a credit to deferred tax liability for 30% of that, which is $13,500, and the 70% portion is to the BCVR account. You can combine these entries, so you've got a debit there to building and a credit. You can combine the two, so it's just a $25,000 debit to buildings, and that is fine. You can choose either method you wish. Now looking at the contingent liability, that provision for the legal claim which was discussed in the question, and because this is recognised for the first time as a liability, it's not within the subsidiaries accounts. You'll have a carrying amount but no tax base, and because of that it will result in actually a deferred tax asset, not a liability. And you can verify that using that table I discussed in topic 1, where you can determine that it's a liability that has a carrying amount greater than the tax base, therefore it would result in a deductible temporary difference when multiplied by the tax rate would equal a deferred tax asset. So the actual consolidation journal entry required to record this contingent liability, it would be a debit to BCVR 2100, which is 70% of the $3,000, then a debit to the DTA account 30% of $3,000, which is $900, and then a credit to provision for legal claim $3,000. Within the acquisition analysis, we calculated a goodwill amount of $13,600. Now to record this amount, we simply debit goodwill by $13,600 and then credit BCVR by $13,600. There's no tax effect to consider in goodwill, which is something we also discussed in topic 1 when accounting for company tax. So these 4 consolidation journal entries we've prepared on the previous slides are added to a consolidation worksheet as shown on this slide. However, please note this isn't a complete consolidation worksheet. There's still a few more things we've got to look at, and we'll do that on the next few slides. However, as you can see here, we've got high-tech and low-tech's accounts listed side by side. Then we've got these adjustments. So we've got the deferred tax, which is a new account created from the consolidation entries. We've got land increased to 210 from 200,000. And buildings is increased, accumulated depreciation is eliminated. We've got the investment still there, but we'll look at that when we do the pre-acquisition entry next, because that would go, that will go. Then we've got goodwill accounted for, which is a new account created via the consolidation process. Then on the credit side, we've got the deferred tax liability account created, and also the BCVR account. Now, one thing I always check when I'm marking assignments is that the BCVR account is 0. It always should be 0. The only reason this isn't 0 is because it's not a complete worksheet. It's just we're breaking up the worksheet for you just to explain things bit by bit. But however, a complete worksheet would have a 0 BCVR balance where the debits and credits equal each other and the residual value is 0. So anyway, just looking at this group column, the final column, this is where the total accounts are placed, and this is the figures that are then taken to the financial statements with the consolidated accounts. So let's look on the next slide how we account for the pre-acquisition entries. So the notion behind a pre-acquisition entry is that you can't have an investment in yourself, nor can you have equity in yourself. And so from a consolidated point of view, these items should not exist, and they need to be eliminated to avoid double counting within the consolidated accounts. So because in this example High-Tech acquired 100% of the share capital of Low-Tech, they gained control of all the individual assets and liabilities of Low-Tech, and within the consolidated accounts, or consolidated statement of financial position, these should be recognized. So this pre-acquisition entry only applies to the equity balances as at date of acquisition, so you don't need to adjust for the movements after the date of acquisition. They're referred to as post-acquisition movements. So if you're preparing consolidated accounts in a period post-acquisition, you're using the pre-acquisition equity balances to perform this this entry. So on the next slide we'll look at the entry required for our High-Tech Low-Tech example. So the pre-acquisition entry eliminates the asset investment in the subsidiary, which is within the parent's accounts, and then the pre-acquisition equity is from the subsidiary's accounts, and we need to eliminate that as well. So our consolidation entry would be firstly a debit to share capital of $300,000, and then a debit to retained earnings of $50,000, and these amounts were stated in the question. The third entry is a debit to BCVR, and I'm just going to park that for a second. And then the next entry, we've got a investment in Low-Tech, $400,000, to eliminate that asset. So where does this $50,000 BCVR come from? Firstly, it's the difference between the debits and credits here, so it's the residual figure. You can figure it out via that way. However, thinking a bit more thoroughly about this, how do we get that figure? So if we were to backtrack and look through all the debits and credits we made to the BCVR account in our previous entries, that should equal a total of $50,000 credit. So this entry effectively clears the account to 0, and by backtracking and checking all your other debits and credits to the BCVR account, you should be able to verify that $50,000 is correct. And this is something I advise the internal students to make sure you check before going to the consolidation worksheet, and then verifying there that your BCVR account equals 0, because it's much easier just to fix up one or two journal entries and fix up your whole consolidation worksheet and backtrack from that point, as to where you went wrong. Here we have the consolidation worksheet again. However, this one is also including the pre-acquisition entry. So I guess you could say this is a complete consolidation worksheet. Now you can see these added entries there, and you can note the values of the investment in low-tech is now 0, and also the BCVR account is now 0, which is what we want to see. We also want to see that the assets in the top there equals the liabilities and equity down the bottom there. So we've got $1,009,500, and that equals on both sides of the equation, which is great, which is what we want to see. These group figures can now be taken, and a consolidated statement of financial position can now be created. There is no statement of profit and loss and other comprehensive income in this example because there's been no period since acquisition to prepare that, and no intergroup transactions to consider. So I guess keep in mind that with this consolidation worksheet we also include the profit and loss accounts as well, and it does get a bit more comprehensive with those added accounts. However, the same method applies with the elimination entries in the group columns, and we just pick our accounts to go to their respective financial statement. And we'll look more at that in topic 4. Just before moving on, we should note that there are some other factors to consider when preparing an acquisition analysis, and it's not covered in the lecture slides, but it is covered in your textbook. Firstly, there are cases where the subsidiary already has recorded goodwill at acquisition date, and when this is apparent, you need to reduce the goodwill by the already recognized amount. So it's deducted in the determination of the fair value of identifiable net assets. And there's an explanation to that, I think, on page 942 as stated on this slide. The second point there says there's also a factor where the subsidiary has recorded dividends at acquisition date, and that's referred to as a cumulative dividend, or cum dividend for short. It could be cum dividend or ex dividend. So when it's cum dividend, it's recorded as a reduction of the consideration transferred, and you need to prepare a journal entry to record that reversal if you're preparing the accounts as at date of acquisition, or if it's being paid, there's no action required, and that's because it's just a matter of cash changing between one party and another, but there's no actual double counting going on. If the dividend's an ex-dividend, you do nothing, no action required, and that's stated on page 944. Now, the notion behind this is when you get a cumulative dividend, it's effectively the entity's effectively acquiring two assets. They're acquiring an investment in a subsidiary and also a dividend receivable. So that's why it's considered a reduction of the consideration transferred. And this is often a concept we like to throw into an assessment question, so it might be worth your while to refer to those pages in the textbook. In the example we just looked at, there was an excess paid to acquire low-tech, meaning they paid more than they received, and that resulted in goodwill. But what happens when you pay less for what you receive? Well, that is considered a gain on bargain purchase, and this is considered a rare event, and as I've already gone through, we need to do some checks and confirm that everything is actually recorded at the correct fair value before recognizing such a gain, because in reality, why would someone sell something for less than it's worth? So just to exemplify what's going on here, if the example instead said that Hi-Tech only paid $360,000 to acquire Low-Tech, the pre-acquisition entry at 30th of June 2016 would instead be, or it'd still be, a debit to share capital $300,000 and a debit to retained earnings $50,000, and the BCVR debit $36,400 stays the same. The investment would instead change to $360,000 instead of $400,000 that was originally recognised, and the difference, which is $26,400, so that's the difference between the $386,400 calculated as the fair value of identifiable net assets against the $360,000, and that difference is considered a credit, which is gain on bargain purchase, and that's put straight into the profit and loss accounts for the within the consolidated accounts. Now, one thing we're going to start talking about in a couple of slides is how does this get treated in subsequent periods, and we go through a bunch of examples there of how to deal with these accounts. However, there isn't one that focuses on how we account for a gain on bargain purchase in subsequent periods. So just to let you know now, the credit would change to retained earnings, and that's because our profit and loss accounts are closed off at the end of the period, and where do they go to? Retained earnings. Now, recreating the acquisition analysis we prepared on slide 35 to use the new cost of acquisition amount of $360,000, there aren't too many changes that occur. Simply, it's the cost of acquisition is now $360,000 instead of $400,000, and that results in, instead of goodwill, a gain on bargain purchase. No changes occur to the consideration amount. So far in our examples, we've been looking at the consolidation journal entries required if a consolidated set of financials were prepared as at the date of acquisition. However, as Learning Objective D said, we also need to consider what happens in subsequent balance dates post-acquisition when we prepare consolidated accounts. So how do transactions and events that occur post-acquisition impact on the business combination valuation adjustment entries, and how do post-acquisition transaction and events impact on the pre-acquisition entry? That's what we're going to look at for the remainder of these slides. So there could be events happen, such as a revalued asset is sold, or there could be that example which I've already gone through about the gain on bargain purchase on future periods that needs to be transferred to retained earnings, or inventories revalued as part of the consolidation process, and that's usually a high turnover asset. So if you were to make the acquisition at the start of the financial reporting period and then it's now the end of the financial reporting period, you'd expect that inventory that was revalued at acquisition date was sold. So there'll be some adjustments required with the consolidation journal entries to account for this. Let's look at a few different events here and how they would be accounted for. So first, with the land, what if during the reporting period 30th of June 2018 it was sold for $250,000? So within Low-Tech's accounts, they would recognize the following journal entry. They'd debit cash, credit the gain of $50,000, and credit the land of $200,000. So they made a gain of $50,000 from that sale. However, from a group viewpoint, the gain on sale was only $40,000. as the carrying amount of the land on consolidation was $210,000. We had revalued that $10,000 as at date of acquisition by an increase of $10,000. So for consolidation purposes, we need to decrease the gain on sale by $10,000, and that will be a debit to the gain on sale account. So I guess this is completely new to what you've learnt in previous subjects. We're now taking it as a given that these accounts are prepared in the subsidiary already, and we're now preparing these entries on top of what's already been recorded to adjust them to their consolidated amounts. Just before we talk about this sale of land in the year ended 30th of June 2018, up until that date, so 30th of June 2016 and the next reporting period 30th of June 2017, we'd keep recording the same consolidation journal entry, which is a debit to land 10,000, credit to DTL 3,000 and credit to BCVR 7,000. In the year the land is sold, we would, as mentioned on the previous slide, debit the land gain on sale of land 10,000. We then credit the income tax expense account by $3,000, and then instead of BCVR, we would credit the transfer from BCVR account for $7,000. Now, there's one other entry that would then be prepared within the 2018 accounts, which would be a subsequent debit to transfer from BCVR account and a credit to BCVR account, and that would clear the BCVR to zero. And then in future years from 2019 onwards, there'll be no further entries required for the land, as in you won't have to prepare this 2018 entry again and again and again, and that's because land is no longer recorded within the subsidiaries accounts. However, this transfer from the BCVR will affect the pre-acquisition entry each year thereafter, and that's noted on slide 60. So what would happen is there's still this $7,000 difference that is recorded, and that's what went into the calculation of goodwill. And the goodwill figure doesn't change if one of these revalued assets is sold. So what we would do in this case is we would put an extra $7,000 as a debit to retained earnings, and then we would have on the other side, it would be a reduction of the BCVR account by $7,000, as we're no longer recording this. So that's how it would work for land. As noted here, also there's inventory sold quite often, usually within 3 months of acquisition. So in subsequent periods, it's accounted for similar to land. There's no depreciation to account for, and the journal entry to prepare would be a debit to cost of sales, a credit to income tax expense, and then this same account again, the transfer from BCVR, which is later closed off. And then in future periods, same applies where there's this adjustment to retained earnings in the BCVR account. Now looking at buildings, a bit more work's involved when adjusting for either the sale of buildings or if time's passed since acquisition when you're dealing with these types of assets. When I say these types of assets, I mean depreciable assets, and that's because the subsidiary is continuing to depreciate the asset based on its cost, which is lower than, say, the fair value usually, which is higher. It can be less, but most of the time in most of the examples we deal with, the fair value is higher. So from a consolidated point of view, the depreciation in the subsidiaries accounts is understated because they're only depreciating at their cost. So we'll need to perform some additional depreciation entries to account for the extra depreciation that should be charged based on this increase we have placed on the value of their buildings to fair value. So here's the calculations that you would do to determine the difference in depreciation amounts charged within Low-Tech, the subsidiaries accounts, and the consolidated group accounts. So here we have the carrying amount for Low-Tech's only $80,000, and the remaining useful life is 8 years, and that will be the same for the group as well. So based on that, $80,000 divided by 8 is $10,000, the annual depreciation rate. However, from a group which has its value at $125,000, dividing that by 8 would equal $15,625 a year. So the annual depreciation difference between the two is $5,625, and we'll need to add that amount each year within the consolidated accounts. And not just this amount, we also need to account for the previous years as well, since consolidation. So if we're looking at 2 years down the track, it would be the $5,625 for the previous year, and then another $5,625 for the current year until the asset is sold. Now, when you're actually preparing the consolidation journal entries and you've got an asset to deal with that is depreciable and a bunch of other assets, I usually just prepare these calculations just below my journal entry within the narration. So 1 year since the acquisition, which would be 30th of June 2017, we need to record the following entry. So this entry in black would stay the same as it was in 30th of June 2016. However, we need to also add in the entries here in red. The first one being the added depreciation calculated in the previous slide via a depreciation expense and a credit to accumulated depreciation. And we've also got this DTL, which is debited by 30% of $5,625, and same again for the income tax expense, that's been credited. And what's happening is this is reversing that deferred tax liability that was recorded up above that $13,500. So over the next 8 years, we'll progressively increase this deferred tax liability balance to account for the prior years, and that will reverse it. We'll also have to, I will look at the next slide, the retained earnings account will need to be involved in accounting for prior year profit and loss amounts. But yeah, that's what the deferred tax liability deduction is doing there. And I guess the same applies with this depreciation expense. That's reducing the portion, the $45,000 portion that has increased, is the increase to fair value. That's progressively been decreased over the next 8 years as well via each depreciation and expense adjustment. Now looking at the buildings 2 years post-acquisition as at 30th of June 2018. The entries in black, we just enter them in again, same as 2016 and 2017. However, if we have a look at the entries in red, a few more things are going on here. So firstly, we've recorded the current year's expense, depreciation expense, via the debit to $5,625. However, if we have a look at the next two entries, we've got a retained earnings debit for $5,625 as well, and that's recording the 2017 year depreciation expense, which was closed off at the end of the period to retained earnings. We've also got accumulated depreciation credit, which has actually doubled to $11,250. So that is including 2017 and 2018's amounts. And then we've got the deferred tax liability, which is both 2017 and 2018's amount. And then again, we've got the income tax expense for the current year and last year's retained earnings. So a few more things to think about when you're dealing with 2 years after acquisition with buildings. It's very important you know the how many periods have gone by between acquisition date and when you prepare the consolidated accounts. So if it was immediately after acquisition, I guess you could think that's the easiest consolidation journal entries to prepare. If it's, say, the acquisition occurred at the start of the reporting period and you've got to prepare the consolidated accounts at the end of the reporting period, it's still within the same reporting period, so you don't need to worry about involving the retained earnings account at all. However, in the years after acquisition, such as this example, 2 years post-acquisition, you'll need to account for the prior income and expense items via the retained earnings here. So if we were dealing with, say, 3 years post-acquisition, that retained earnings amount for recording the depreciation would increase to $11,250 to record the 2017 and 2018 amounts. The depreciation expense would still be $5,625, and the accumulated depreciation account would increase to $11,250 plus $5,625 equals $16,875, and that will just continue on over the 8 years. And likewise, the deferred tax liability, that would be 1687.5 times 3 years. That would be 5,062.5, and the income tax expense would stay the same because you're only doing the current year's adjustment there, and then retained earnings would include 2017 and 2018. So doubling that would be 3,375. So now looking at the contingent liability, let's say on the 1st of January 2017 the legal claim was settled for $2,000. On slide 40 earlier we recognised this provision entry as $3,000. So on settlement, Lowtech would recognise the following journal entry within the subsidiaries accounts. They would debit legal fees, which is an expense, for $2,000, and then they would credit cash. So as this liability no longer exists, it should not continue to be carried forward within the consolidated accounts. And for our purposes, we need to record a different entry when we prepare the consolidated accounts to recognise this gain on settlement. And it's a gain because they ended up only having to pay $2,000, but we provisioned for $3,000 at acquisition date. So in the 30th of June 2016 accounts, we recorded the debit to BCVR $2,100, which was 70% of the $3,000, a DTA, deferred tax asset, of $900, and a credit for provision of legal claim $3,000. And the liability was settled in the next financial year, 30th of June 2017. So the first entry we'll perform is a transfer from BCVR, and that will be $2,100 again. So just remember, once this entry is complete, at the end you just do a reversal where you would then credit this transfer from BCVR and then debit BCVR to clear it to zero. Next, instead of deferred tax asset, we have income tax expense, which is a debit of $900. And then we're going to reverse this expense for legal fees, so there will be no recognition of that, which was originally placed within the subsidiaries accounts. And then we're going to recognise a net $1,000 gain on settlement. So in future years, say from 2018 onwards, there's no entry required. Don't need to perform this 30th of June 2017 entry again. However, just like before with the sale of land and inventory I talked about a few slides ago, you will need to adjust the retained earnings in the BCVR account by the $2,100, 70% of the provision. Looking at goodwill post-acquisition date now. So we calculated previously the goodwill as at acquisition date was $13,600. Say the following year, 30th of June 2017, goodwill has a recoverable amount of $13,000, and therefore it needs to be impaired to reduce the $13,600 down to $13,000. So the following entry would need to be entered. As at 30th of June 2017, we would debit goodwill by the original amount, $13,600, and we would credit the BCVR account, $13,600. However, afterwards, we would then debit impairment expense by $600, and then credit goodwill accumulated impairment losses, $600. And that would happen within the 2017 accounts. And say in future years we would still need to record this impairment amount. However, because the impairment expense is a profit and loss account, we wouldn't use that account again. That would change to retained earnings, but all the other accounts would remain the same. When there's a transfer of the pre-acquisition reserves subsequent to acquisition date, there's a change required to the pre-acquisition elimination entry. And I talked about a few of these examples previously where we had a sale of an asset or a contingent liability realised, and as it says in this second point, consider the sale of land. So we're going to look at on the next slide how that would change the pre-acquisition entry we prepared previously as at 30th of June 2016 to what we would have to do post that sale. There are other types of situations that will cause the pre-acquisition entry to change. So there could be say a transfer between pre-acquisition retained earnings and other reserves, or a bonus share dividend paid from pre-acquisition equity. And I think there's a bit of discussion about that on there's a discussion on the bonus share dividend on page 955, but there's also some more discussion on transfers of pre-acquisition reserves on pages 956, 957 of the textbook. Alright, so these entries are focusing on 2018 and 2019. So you're aware, this entry up the top would be the same in 2016 and 2017. Nothing would change there. However, in the year ended 30th of June 2018, with regards to land, we're only focusing on land in this example. We would first need to clear that transfer from BCVR account and credit the BCVR account, and that would reduce both balances to zero. So that would happen in the year that the land was sold. However, going forward, we would have this adjustment to retained earnings and BCVR. As you can see, the retained earnings debit has increased, so it's reduced its balance more. And we've also got a decrease in the BCVR. It's now $43,000. So the share capital account and the investment account, they stay the same. It's just been an adjustment within those two entries. I've already gone through this in an earlier slide, so I won't spend too much time on it. This is just reiterating the fact that you have a choice for some types of assets to either revalue them within the subsidiary or on consolidation. Much easier to just do it within the subsidiaries accounts because you don't need to worry about revaluing them each period at consolidation. However, in practice it's quite often done within the consolidated accounts and the questions that we give you. So you've got a choice with property, plant and equipment. However, with inventories you don't have a choice. You pretty much have to prepare a revaluation on consolidation, and that's because within AASB 102 it says that inventory has to be measured at the lower of cost or net realizable value. There's no mention of fair value there. And internally generated assets, such as intangible assets, can't be recognized as an asset. So until the consolidation occurs, they don't meet the recognition criteria to be within the subsidiaries accounts. And that's it for Learning Objective D. I've just included these last two slides which just discuss disclosure requirements a little bit. I'm not going to spend too much time talking about these as they're not the focus of this topic. However, it just says here that the disclosure requirements are contained within Appendix B of AASB 3, B 64 to 67, and AASB 12, which we haven't touched too much, discusses disclosure of interests in other entities. And the key objective of that standard is to provide information that enables users of financial statements to enable the nature of risks associated with its interests in other entities and the effects of those interests on its financial position, performance, and cash flows. And there's some examples covered in, I think, Chapter 18 and also Figure 19.18. And also AASB 127, separate financial statements, sets out the disclosures required in separate financial statements.